Welcome to Understanding Real Estate Cap Rates. I'm overwhelmed by the response. This has been much more than I expected, which is awesome. I really love real estate Twitter, and I'm really glad that you all had an opportunity to join today. I will be recording this, so people who missed it, I will try to share it the easiest way possible. So a little bit about me. If you follow me on Twitter, I'm Kribdilla. I am a real estate broker and advisor based in New York City. I'm also a professor at New York University. I teach real estate economics and market analysis. I've done that for about 14 years. I've also taught the negotiation and dispute resolution classes and work with Maven to try to develop a cohort class based around the market analysis and economics class I teach at NYU. And this cap rate discussion is taken from a small part of that larger class, which I hope to share more information with you about that later on. With that in mind, here is what we're going to talk about today. So we're going to cover what is a cap rate. We're going to go through the four components of a cap rate, how cap rates ought to be a function of risk, and we'll talk about some conclusions and some questions. If we can, I'd like to hold questions off until the end. That way we can just, anything that you don't like about what I'm saying or you want to ask more about, can just cover. Everybody has that opportunity at the very end. So what is a cap rate? Moses from, now over a year ago, had this fantastic, very concise definition. And I think this really encapsulates this pretty well. Cap rate is what you buy. Unlevered yield on cost is what you create. And this is an important definition because what we want to think about when we want to think about a cap rate, it's really a snapshot in time. It's what we're buying. It's what we're looking at. It's what we're analyzing, what we hope the NOI that will be on day one for the first year of ownership, and we're determining our price based on that NOI. When we think about cap rates, it's important to note we're always talking about it in terms of an unlevered return. Unlevered, of course, means without debt. It's as if we would be buying the NOI or buying the revenue stream of the asset without any debt on the property. And the reason we do that is commercial real estate debt costs vary widely depending on the borrower, depending on the terms that people are seeking. And the only way to make an apples to apples comparison is to eliminate that variable for debt. Now, that does not mean that we don't borrow, right? Of course we do. Most investors are using leverage to buy real estate. So debt is a function of our consideration, but when we're looking at assets and we're thinking about cap rates, we're excluding debt as a consideration there so that we can make an apples to apples comparison across asset types that we might be considering. As I mentioned, a cap rate is a going in return. Going in means, again, on day one, and it's with a reasonably expected expenses cost. So when we look at a pro forma, we're not looking at what the broker says. We're not looking at what we hope may happen if everything works out perfectly. It's checking ourselves, looking at our expenses, making sure what we're projecting is reasonable. Next thing, when we define cap rates, we want to make sure we understand that cap rates are derived. What we mean by derived is we must know or project the NOI of the asset, the net operating income. Once we have done that and we know the purchase price, we know what the cap rate is. We're not thinking about real estate investments as buying a 6 cap, buying a 5 cap, buying a 7.5 cap. We're really looking at the NOI. We're looking at the purchase price that we think is the right purchase price. And when we know those two things, we'll know what the cap rate is that we're paying. So it's a derived thing. It is not an objective, it's a calculation. Now, this is not to say that markets don't have prevailing cap rate environments. Of course they do. At any given time, a multifamily in the Sun Belt is going to be trading at a market cap rate. What that means, though, is it's all of the combined transactions in that marketplace. So we have a prevailing cap rate, but we have to understand that each one of those cap rates are individual, unique parcels of real estate, and the investors who are demonstrating price discovery when they're trying to figure out what the right market price for that asset will be, each one of those transactions is happening independently of each other. And what we want to make sure we avoid here is what I call the market cap rate trap. I get this frequently from investors wanting to buy in New York City as an example, and they want to talk to me about what the right cap rate is for certain assets. And that's really not the right way to think about an acquisition. And the reason for that is every single property is unique. Its income profile is going to be different from its neighbor. In dense urban markets, it's not uncommon where you'll have whole blocks of real estate were built at one time. So you're looking at 4 or 5 or 6 buildings in a row. They're all 6-story buildings. They were built by the same developer in 1920. And presumably they all have similar layouts when you're looking at them from the street. But 1910 or 1920 is a long time ago. Over the last 100 years, each one of those properties has been owned by a different owner and multiple owners, different management, different tenancy profiles, different ways they spend money or maximize returns, different types of deferred maintenance. So each parcel has to be considered on its own for its potential as a return vehicle. Because at the end of the day, that's what real estate is. It's a return vehicle. You're investing money today, and you're going to gather that return, or you're going to obtain that return on an annual basis during your hold period. So what are the prospects for return there? Last thing here is we're going to look at the rent roll and a cap rate matrix, just so that we make sure we're talking and understanding what we're referring to here. So on the left-hand side, what we have is, this is actually a real asset in New York. It's a free market, 12-unit building, shows what the square footages and the rents are for each apartment and the annual income. We have projected and actual expenses, and we have the net operating income of $237,470. On the right-hand side of the page is a cap rate matrix. And if you notice, the NOI line, of course, is fixed. If we're looking at buying the asset represented by this rent roll on the left-hand side, we are not going to change the NOI based on what we're going to pay for it. Because again, NOI is what we think the NOI is going to be at acquisition in the first year of ownership. It's a reasonable expectation of what we think we're going to collect, less our expenses. Once we own it, we get to make decisions about how we spend money, whether we spend more, whether we spend less than the seller, whether we try to maximize returns based on some management thing that we're doing, get new tenants in place and increase the income. All of those things that we're, of course, going to do once we own the asset, but we don't own it yet. We're trying to figure out what the right price is. So on the left-hand column, NOI is all the same. The middle column is the cap rate. It's included this in here because I want to make sure we understand and visualize that cap rates severely influence value. If we're in an 8 cap environment with the same NOI, the value of that 12-unit building is just under $3 million. In a 3 cap environment, that same NOI is worth $8 million. And as you can see from the matrix, and it's pretty clearly outlined here, it's an inverse relationship to value. The higher the cap rate, the lower the value. The lower the cap rate, the higher the value. If you're buying something for a 7 cap, you're getting a 7% return on the unlevered basis for that NOI. If you're buying a 6 cap, 5 cap, etc. Okay, Cribdillo, WTF, isn't this just math? Yes, it is just math. Sort of. So far, you probably all have considered this and said, yeah, why are we here? Once we know the NOI and the purchase price, we know the cap rate, we can project that out. But how do we know what cap rate is the right one? How do we know that we're paying what we ought to be paying for the return for this individual unique asset? Well, that's where the 4 components of the cap rate come in. It's generally understood that cap rates have 4 components. You probably include most of these, even if you're doing it subconsciously. You may not have ever had it enumerated this way, but you are making a consideration because it's implicit in the real estate investment. But we need to make sure we're considering it when we're making an investment decision. So the 4 components are long-term interest rates in the economy, expectation of property level rent growth, the credit of the tenancy, and then treatment of real estate taxes in the local tax code. And we're going to talk about each one. So the first component is long-term interest rates in the economy. The chart that we're seeing here has 3 lines, right? We've got in light blue, the Fed funds rate. In red, we have the 10-year treasury, and in green, we have the 30-year fixed rate mortgage. 30-year is a single-family home. It's not commercial. The different borrowing costs that we talked about before, it's very difficult to get projection that makes sense, and everybody sort of understands this idea of fluctuation in the 30-year borrowing rate. It's pretty commonly understood there. So what are we looking at here? Well, what we see here is as the Fed funds rate rises and falls, borrowing costs rise and fall. They are doing their job. When the Fed raised interest rates 25 basis points yesterday, the objective they have is to put upward pressure on borrowing costs to make it more expensive to invest in assets and equipment and spend money, make it more painful to spend money. People will spend less of it, or the threshold to actually invest money in an asset will need to be higher. If we understand that cap rates have an inverse relationship, it means we're spending less on the investment, we're going to get a higher return. So higher interest rates, lower asset prices, higher returns, higher cap rates. Lower interest rates, lower cap rates, lower returns. This is not groundbreaking, but we do need to understand that as interest rates go up, asset prices fall. As interest rates decline, asset prices get bid up. More investors think about buying assets, those asset prices tend to go up. And the last point here, for stabilized assets, the going in return should be higher than the cost to borrow money. When we say stabilized here, what we mean by that is market rate buildings that are currently getting market rent, not market rate, but market rent buildings. You have a tenant in place. The tenant is paying prevailing market rent. There's no, management upside immediately on lease rollover, something like that. You ought to be getting, at a minimum, you should be making more than the cost it is to borrow money. That's a typical thing. It doesn't mean you have to. There are other components of the cap rate where it may make sense for it to be less than borrowing costs. But if we were only looking at interest rates, that would be one threshold that we would want to make sure that we consider. The next component of the cap rate is property level rent growth. What this means when we say property level is the property itself has an opportunity to increase rents. It can increase rents in a bunch of ways, right? It can increase rents because the market rents are growing. You're in a favorable demographic that has a lot of demand for real estate assets. Rents are going up because there's constrained supply. You have a high expectation that market rents are going to increase over time. People love to talk about Los Angeles. Not a lot of developable land. It's difficult to build there because of NIMBY and other things. If you can own an asset, you have a higher expectation of that rent increasing over time. You also can grow property level rents because you have relatively low rents. Your leases, you got long-term leases rolling over to market. Market has rapidly increased over the lease period. And now you have rents that are 10, 20, 30, 40% below market. If you know that market really well, and that's the important key, that you can actually execute on this idea of the third thing here is repositioning through either re-tenanting or upgrading. This is this idea that if you dramatically changing, right? This isn't you're keeping the same tenants in place and you have an expectation of renewing them at much higher rents. This is where you're taking an asset and changing it. Could be completely redeveloping it to luxury. It could be getting rid of a tenant or not renewing a tenant that doesn't necessarily reflect the type of asset that you want to own. And you are letting the space go vacant. You're going to hire a broker. You're going to lease it up to a brand new tenant. Understanding that all of those repositioning costs add to your acquisition cost. This is where you get this thing otherwise known as unlevered yield on cost or levered yield on cost. It's no longer cap rate. It's not a cap rate because you're managing it, you're incurring costs, you're investing in the asset through time and money. So now you're looking at something like an unlevered yield on cost, not a cap rate. And the last thing to consider here is downward pressure on rents. We all like to think that rents only go up, but the fact of the matter is, especially when rents have spiked, we see plateaus or declines in rents. We saw it in New York City in 2018 and 19. Rents had dramatically increased into that period of time, and we saw market rate rents plateauing. Right? Doesn't mean property level rents were plateauing. It means market rents were slowing dramatically. We're seeing that in Sunbelt states. We saw a high expectation of rent growth. We did see spike in rents driven by COVID demographic changes, high demand rapidly, and all of a sudden rents spiked. We're seeing that cooling off. We're seeing rents fall in those markets. So if you have a low expectation of property level rent growth, that's okay, right? It doesn't mean that you shouldn't buy. It just means you shouldn't overpay for that asset. You're going to pay a higher cap rate, a lower value to make sure you're compensated for your investment. Third thing, credit of the tenancy. Credit of the tenancy, we see in our pro forma line here, our expense line, as vacancy and credit loss. We typically say that in a multifamily asset, 3%, 4%, 5%, whatever it is. Typically in commercial real estate, when we say the credit of the tenancy, we're referring to things like retail tenants or office tenants. where you may have a mom and pop store versus a national tenant. Mom and pop doesn't have nearly the credit of a corporate-backed national tenant. Your expectation of payment for that rent is less with a mom and pop than it is with a national tenant. Therefore, with a national tenant, you can pay a higher price, therefore a lower cap rate. You're getting cap rate compression because you have a high degree of certainty that you're going to get paid at least in the near term. So that's how we typically talk about credit of the tenancy. But we also are starting to see something. It's always existed, but it's coming up more frequently now. Is this idea of legislative or legal credit? This is more like a market issue. Typically, and I shouldn't say typically. We definitely see it in New York City. New York City, if you have a problem tenant, it's difficult to evict. It has always been difficult to evict those tenants. It may take 6 months to a year. That was pre-COVID. Now we have lots of other red tape issues about trying to remove tenants and proposals for things like non-eviction. If you are investing in a market that has a high degree of difficulty of evicting non-paying tenants, you need to factor that in the cost of ownership. Your long-term prospects for collecting all of the contract rent that is owed is lower in that type of a market versus a market like Florida or Texas, where you have more favorable landlord laws where it's easier to get the marshal to come to evict tenants for non-payment. So we want to think of this as credit of the tenancy. It's either the tenants themselves or the market that you're operating in. The last one is treatment of real estate taxes in the tax code. Just so happens that our friend Baker has been talking about this quite a bit. And it is when he talks about his investments in Texas and how his real estate tax payments have come due. And it's so brutal in Texas that it marks to market every bleeping year. That's basically like paying a gross receipt tax to a franchisor. So the idea here is Texas, you're in business with Texas if you own a property in Texas. Why is that? Well, Texas, because it has low or no state taxes, relies pretty heavily on real estate taxes to support the local and state municipalities. So they look to landlords to fund their operations. It's not just Texas, though. New Jersey and New York also have very high taxes, relatively speaking. And in New York City, you have what are called protected asset classes, and you have non-protected real estate asset classes. 1 and 2 family brownstones, tax increases are capped. 6 families are going to fluctuate with the market. Your taxes can increase dramatically. So when you're thinking about your fourth component of the cap rate, you're talking about real estate taxes in the tax code. Why is this important? It's because the long-term ownership of real estate means that every year you will face the potential of having significantly higher taxes from the year before. And real estate taxes are what we consider to be an above the line expense. It means they come out of income before we calculate NOI. So with the NOI number decreasing because of higher real estate taxes next year, it means that it's going to potentially affect the future value of your assets. You have to factor that in when you are making an investment decision. So that's the 4 components of the cap rate. One more thing, though. I want to make it clear that when we're talking about cap rates, we are supposed to be talking about them as a reflection of risk. What does that mean? What it means is a high cap rate asset, meaning a high return asset, 6, 7, 8, 9, 10, right? High cap rates. It means that you are exposed to a higher level of risk by definition. It is possible that an asset is mispriced. It is possible there's an inefficiency. It's poorly marketed, it's poorly owned, it's a high cap rate, and it really should be a much lower cap rate. Ideally, that's what we are targeting as investors. Okay, we want to capitalize on something that's mispriced. It should be a 6 cap, its price is a 7 cap, perfect, boom. But in the event that it's not, and more often than not, it's not, if you're getting a high cap rate return, you are facing market risk. There is some market risk in there that you need to determine why it's priced the way it's priced. There is no free lunch. Conversely, in a low cap rate environment, your low cap rate should reflect relative security of income. If you're going to buy an asset, a real estate asset at 3.5 cap, you better be pretty sure you're going to get that 3.5% return year over year. because you're paying a lot of money for it. It should be relatively risk less. And if there's risk in there that you're not being compensated for, it means on a risk adjusted basis, it's a bad investment. So cap rates are a reflection, or should be a reflection, of risk. And historically, they have been. When you talk about multifamily in a dense urban market where there's lots of demand, those are relatively lower cap rates, because high demand means you're going to have less opportunity for high vacancy and more opportunity to lease those properties when they roll over. In a less dense market, you ought to have a higher cap rate because there's less demand, less job growth. Doesn't mean it's a bad market. It can be an awesome market. It can be a great market for, investment and long-term prospects and all those things, because it's really, really stable, and that's great. But you want to make sure that if you're investing in a tertiary market, you're being compensated for the underlying market risk that's there. And one of the things that we've seen in this last cycle is this idea of cap rate ambiguity, agnostic cap rates. The cap rates in Allentown, West Virginia, or Allentown, Pennsylvania, are the same as they are in LA, or the same as they are in New York City. And that is, historically speaking, not something that we've seen. And it doesn't mean Allentown's bad. Allentown's wonderful. Its long-term prospects are very different than LA and New York, and you need to be compensated for that additional risk. So, in conclusion, what's a cap rate? Hopefully, you have a better understanding, or can articulate more about what cap rates actually are. You probably knew a lot. Hopefully, you learned a little bit more. Know the four components: interest rates, expectation of rent growth, credit of the tenancy, and how real estate taxes ought to be priced in. Are there any questions?
Hey, I was just wondering, what do you see long term as far as cap rates? Are they going to trend with interest rates? What's the relationship there? Are they going to stay parallel with the interest rates, 10-year or whatever?
I think it depends on the market, and I think it depends on I think, let me answer that in a different way. I think that we've very likely, at least in the short term or in the near term, the Fed is probably pretty close to its contractionary policies, meaning trying to slow down the economy. The 25 basis point increase is an indication of that, although I think that's been priced in for a while. And I would say that my expectations are, and if you follow me on Twitter, this is no shock, I think that in the period from March of 2020 till probably 6 months ago, when the market sort of dramatically changed, I think that was an anomaly in a capital market. Yes, we saw, if we go back to the interest rate chart that I showed, we've had the Fed funds rate at or near 0% before. We had it for a long period of time just after the Great Recession, and in 2018, the Fed started to push up interest rates because it looked like we needed to start thinking about less accommodative policies. And then COVID hit, and it wasn't just the interest rates were lowered, but it was just massive amounts of monetary policy and fiscal policy. Fiscal policy, of course, being PPP and giving anyone and everyone money because the economy was grinding to a halt. I think it was a great use of our money. I think it was a brilliant way to keep us out of a potentially severe depression. But the consequences of that were hyperinflated stock market and hyperinflated assets, including real estate. And I think that we are going to normalize at a normalized rate, which is cap rates around 5s and 6s, borrowing costs around 5 for commercial properties on a fixed rate basis, in the 5 to 6% range. That doesn't mean you can't get lower than that if you take on interest rate risk by taking floating rate debt or something like that. And you can certainly be opportunistic about how you borrow. But I think cap rates are very likely going to normalize. The days of 3 caps are over. If I'm wrong, I can be wrong. And I think if I'm wrong, what's caused me to be wrong will be some exogenous factor that we just can't predict. And what that would be is like war, a return of COVID that requires another massive immobilization from the government to spend money and to get people to spend money in the economy. That could happen. I'm not saying I know what the future is. I'm just saying, if you look historically, interest rates were very, very low for a very, very long time, but it's not just the interest rates. It was all that money sloshing around in the economy. And we've had a high money supply before. What we had this time was different, was everybody was essentially given money and didn't have a lot of ways to spend it because the economy was shut down. And so you had just excess capital, and we had, real opportunity. I mean, population shifts happened and lots of money was made in that cap rate compression that took place. And there was a lot of excitement about it. I would not place money on that returning. It maybe is the better way to say it. Great question. Anybody have another question?
Yeah, I do. What's the play if you live in a place and you want to invest in that local market? You don't want to go out of state because that's a hassle, but it's traditionally where I live has extremely low cap rates. Like,
do you mind disclosing where you live?
Boulder County, Colorado.
I don't want to pretend that I'm an expert in Boulder. I think that there's a couple of ways to capitalize that on. The one is you look for, what we call off-market opportunities. And what that really means is you do the legwork yourself. You don't rely on a broker to bring something to you. You actually reach out as an investor to whatever type of asset you like to buy, because the way that those people get to brokers, the way they get to being listed is that they very likely were either cold called or got mail from a broker and they decided to sell. I mean, I'm a big believer in swimming in your own pool. I think it's very risky when people go outside of their sphere of expertise to invest in real estate, because real estate is a very local investment. And if you're going to go outside of your market, you really need to spend time in the market you're looking at and learning it and making sure you're not the dumb money coming in. But I think opportunities exist in every market. And I would say that even in a low cap rate environment, low cap rates are okay. As long as you're, one, being compensated for, if it's a low cap rate, it ought to be pretty secure. That low cap rate on a national tenant that goes out of business and nobody wants that national tenant location. Saw lots of Starbucks go dark in the last, whatever it was, 5 years or something. Starbucks expanded dramatically. And then all of a sudden they contracted and they operated their stores dark. And the reality is if Starbucks couldn't make that location work, it's probably pretty difficult for others. It's certainly not at the rent that you probably paid if you invested in that Starbucks location. So, I should say the revenue stream relative to the rent. So, I think, but there are opportunities in every market. And I, as much as I say, 3.5 caps are stupid, they are most of the time. It doesn't mean they're always stupid, right? There are certainly places where they make sense. It's really, really hard to operate a real estate property on a 3.5 cap, on a 3.5% margin. It doesn't take a lot of things to go wrong in that asset for you not to be able to pay your mortgage if you're paying a 3.5 cap. Now you can put just no leverage on it or very, very low leverage, but then is that a efficient use of capital? And I would argue it probably isn't. It doesn't necessarily mean that all 3.5 caps are bad, but it really, there needs to be some real repositioning risk. I mean, one of the things that we saw with 3.5 caps in the last, in the run up into 2022, this idea of loss to lease, upside, pro forma upside, and an asset trading 3 times in less than 10 years, ever increasing purchase price. And if you look at because they were published, if you look at the offering memo from the broker, the first time it was sold 7 years ago, it looks identical. Nothing has been done. All you had essentially was cap rate compression and some rent growth. That's great, right? The rent growth is nice, but if that slows down, if your rent growth slows down and you've paid a huge premium because of cap rate compression, and the market returns to like a 5, which is historically still really low. I mean, 5 caps in the mid 2000s, 5 caps in New York City were relatively rare for regular sort of mid-market assets. So in Sunbelt states, that's still really low. And if you hear 5 cap today, everyone's like, holy smokes, the market's returned. Well, longer term investors look at that and say, yeah, the Sunbelt states, talk about downward pressure on rents. There's no barriers to entry, right? Everyone talks about it's really hard to develop. Well, that's true, but in a 5-year period, it's not, right? And so your pipeline of assets being added to that market can be dramatic, and that downward pressure on rents, because while you're owning that 1985 asset or 2001 asset, you're competing with something in 2 years that's a 2004 or 5 2024 or 25 asset. Right. And so your obsolescence, right? You're sort of graduating out of luxury and into, B class. So those are all things that you sort of have to consider. And that's where, when you think about cap rates, it's like, all right, a 3.5 cap in a Sunbelt state can be okay under certain circumstances, but those circumstances have to really be considered. You got to go in with your eyes wide open. And what you don't want to do is rely on, one of the things that I tell my clients and my students is, you don't want to rely on perfect execution in real estate. You can make numbers work if everything breaks in your favor 100% of the time. Most business plans will probably work. But anybody who's spent any time in real estate knows that your business plan changes the minute you put your pen down. Something has happened. That's how frequently you have issues in real estate. And that's why real estate, when we talk about real estate returns, they're relatively high, right? It's not stocks that you can trade out every day. You have to be compensated for the risk that you're taking on. So real estate has two returns. It's got the annual return, that cap rate kind of return, but underlying appreciation. You pay a 3.5 cap and it expands to 5 caps. You just destroyed much of your underlying appreciation potential until, for 10 years or more, if it goes back to a 5 cap market. So great question.
Do you find your cap rate comps just on Crexi or LoopNet or for your particular market?
God, that's a great question. I don't rely on Crexi or LoopNet for cap rate numbers because they're generally wrong. We're active enough in the markets that we're in that, meaning we're underwriting deals and know what they're trading at, so we know what the real cap rates are. Frequently what's in CoStar and Crexi it's just wrong. I mean, because it's it's the way they get that information is, and I'm sure you've looked at broker OMs that, you look at it and you're like, okay, great. Let's just assume the revenue number's right. Like, let's assume, and that assumption isn't always true, right? But then you look at the expenses line and you're like, oh, I know it costs, $10 a foot to operate a building, this B-class office building, right? That's just what the average market expenses are. And you look and you're like, oh, they're operating at $5 a foot. Now that's possible that's happening, right? But it's unlikely, or there's a reason they're managing some other buildings and they're not really charging for management of it. I mean, you see that a lot, right? You look at the balance sheet, the P&L statement, and you're like, oh yeah, this is what they're paying in management fees. But then you're like, well, that doesn't make sense. And then all of a sudden you find, well, they've got a team of people that are working on 5 buildings and this one's lumped in there. So you have artificially low costs. So I don't, to answer your question, the other thing too is this is going to sound a little flippant, but I don't really care. And that's not to suggest, like, if I don't get a 7 cap, I don't care if everyone's paying 5 caps. Of course, if the prevailing market cap rate is a 5% cap rate, that's going to be a function of debt. It's going to be a function of where things are trading, and we're active enough in the market that I know that, right? But whether something's is okay at a 4.8 or a 5.4, that, relatively speaking, that's a lot of money. That's not a small amount of money. And so it does, because the asset has an income and, a revenue potential and NOI potential on its own. And so somewhere around that 5% is, if that's where the market is the right number. But, comps don't, and that's why price per foot and price per door and all of those things are, or replacement cost. I mean, a lot of it is, it's important if it's important in that market, but most dense urban markets, it's not as important. What tenants can you get in there? What tenants are going to be paying for that? Where are rents for those types of tenants in the broader market? What's the demand there? Those are all things that are far higher before you get to a price per foot number. A price per foot number can be important, but it's usually not the top 3 or 4 for sure.
And on a new build, like I said, we came out with a building starting, January 1. We just got a COO on a 50 unit building.
Congratulations.
Cap rates there would be probably a little bit lower than a 30-year-old building, or where they have a lot of deferred maintenance.
Well, yes, assuming you're getting, like all things being equal, right? Because you could argue that a 1985 building that's got artificially low rents is going to have a lower cap rate than that, because whoever buys it's going to reposition and increase the rents. But I would argue those are not apples and apples. So you're really in that situation. Where's the asset?
We build in Utah, Salt Lake area.
Okay, so I would argue that you're competing with the other things that have been delivered to market in the last couple of years, and new stuff, right? I would, if you can command higher rents at higher demand, then it demands a lower cap rate, or it warrants a lower cap rate for sure. But is your location as good as your competing one? If it's better, then yes. If it's not as good, then you have to adjust for that, right? But yeah, newer buildings, remember, it becomes a market issue too, right? As Salt Lake City, if it continues to grow like gangbusters and you have relatively constrained supply and have a high expectation of rent growth, a lower cap rate on a new building is okay. If you're building into a lot of supply coming online and not as much demand, you're ultimately your price is going to suffer, and that means your cap rate's going to be higher. I mean, it's not a mystery, right? It's the
Gotcha.
The next question. I'm not looking at the chat. If anybody wants to, I can if you want me to, but.
Yeah, I had a question about what you're just kind of talking about briefly, about just
Sure.
kind of when you're analyzing an acquisition, you're kind of talking about the OM, and when you're reviewing, you said price per square foot, and those things aren't necessarily as important, but what would be like your top 3 that you're looking for, your top 5 that when you're looking at a deal and you're like, hey, this is kind of what it needs for me to even be interested? I know it depends, because every market is different.
It really depends, and I think the I'm not as cynical as I sound, but I would say that let me just step back and paint sort of a bigger picture. When brokers can market on cap rates, that's the first thing they do. If they can't market on cap rates, then they go to usually price per foot. And if they can't market on price per foot, they market on replacement cost. And what I mean by that is cap rate is, replacement cost is the true definition of replacement cost is I had to rebuild the building today, what would it cost? And often what happens is, and I should say, I would even say something as crazy as like 95% of the time, if you look at a broker claiming that something is below replacement cost, it's way above what it will cost to replace that building, the actual bricks and labor required, and the faucets and sinks and bathtubs or whatever you're looking at, right? And the reason they say that is because they have some huge number for land. And the problem with that is, the thing about building a building is the land is where the price fluctuates the most. Okay. And I'll give you an example. In 2008 and 9, sort of when the market had collapsed, one of the everybody's heard about the Big Short and, shorting that market. Great. That was brilliant and all that stuff, right? One of the most successful investors coming out of the, not the only one, and I don't know all the investors, but so this is, I forgive the hyperbole, but one of the best investment stories I heard was a student of mine worked for a company based here in New York City. And the buyer, the founder of the company His investment thesis coming out of the recession was buy every single parcel of land he could find anywhere in the country, didn't matter. Because his thesis was land had fallen effectively 95% in value. You could buy land at 5 cents on the dollar in 2009 that you had to pay for the same parcel of land in 2007. And that was almost agnostic market-wise. He bought like 5,000 or 8,000, something like that, parcels of land throughout the country. Brilliant. Everybody else was like, land is dead, right? And if I can buy something at a discount of 50%, look at me, I'm crushing it, right? The investment thesis on 5 cents on the dollar is, if it goes to 10 cents on the dollar, I've doubled my money. I've got 100% return at 10 cents on the dollar, right? So land can fluctuate very, very dramatically. So when you're talking about replacement cost, it's kind of hard in a dense urban market to get below true replacement cost. And if you do, there's usually a big reason why. Could be a brownfield, it could be it's subject to some kind of rent control, rent stabilization, or something like that. So when I look at, going back to your question, when I look at a broker who's marketing replacement cost, I'm like, okay, A, do you even understand what replacement cost is? And if you're at $700 a foot for something, or $600 a foot, you're probably not talking about replacement cost there, right? Doesn't mean you're not, right? We're not talking about, skyscrapers here. We're talking about, walk-up buildings or whatever, right? So then you get to, price per foot. Well, price per foot doesn't really tell you anything. At the end of the day, price per foot's kind of like a replacement cost number. It's like, all right, well, at price per foot, it's attractive, but do the rents support that price per foot? The best metric for do the rents support the value that you're asking is cap rate. What return am I getting based on the in-place rents? And can I borrow enough money on that where leverage makes sense? Am I getting a return where I can, is the return too low, but I can somehow turn it to something better in the next 3 to 5 years because I can reposition it because of something happening in the market or something happening at that location? So when you get beyond cap rates, it doesn't, I don't want to say that none of them make sense. Of course, there are, I just posted on Twitter a big deal I just closed last week, office building in Irvington. And on a price per foot basis, it's an amazing deal, but it's truly below replacement cost. I think we're into it. The buyer was into it for something around like $150 or $170 a foot or something like that, which is ridiculously low. You can't on that low. I mean, this is water on the Hudson River. I mean, this is land on the Hudson River. It's right by a train station. The land is arguably worth pretty close to that. And this is a building that's built that's 90+% occupied. And so, yeah, that's you look when we go to a lender and say, hey, this price per foot is very, very compelling. It is compelling. There's no question. It's very, very compelling, but you can't eat price per foot. Just like you can't eat IRR, you can't eat price per foot. It doesn't really, tenants don't care. They don't care at all. They care, well, if I don't rent from you, or I'll rent from somebody else, and what am I going to pay over there? Why would I rent for you for more? It's market rent relative to price. That makes, in my estimation, is the where the rubber meets the road. Great question.
Yeah, thanks. I really appreciate it. And disclaimer, I'm an investor, but also a broker, so it's helpful.
Oh yeah. Listen, I only brokers can talk crap about brokers.
Yeah. Right. Okay. No, thank you.
Anyway, okay. Other questions? We got plenty of time now that I apologize about the Zoom thing. I've apparently always used NYU's Zoom. I've never had my own Zoom account, so I forgot you had to do that. So, other questions? Nothing else? All right, everybody. Thank you.
There's someone.
Oh, there's some.
Yeah, there's some in the chat.
Yeah. Let me pull that up. Why is my chat not here? Anybody want to ask? I'm trying to. Oh, there's the chat. Sorry. Okay, will it be available? Okay, I will try to post the recording. You guys can hear me. What's the difference between property versus market rent? Isn't property a specific data point within the market? Well, property level rent. Okay, so what I mean by that is okay, so the easiest way to say this is let's say you do a market analysis and you've got, depending on the size of your market, in a place like New York City, it could be 10, 20, 30 blocks, right? It's not we have micro markets and dense urban markets like that. Prevailing market rent in those 30 blocks for a 1-bedroom apartment is $3,500 a month, or let's call it $65 a foot a year. Okay, that's market rent. Your property may be getting 50 a foot. Your property might be getting 65 a foot above market, or 70 a foot, right? If you're getting 50 a foot and the prevailing market rent is 65 a foot, can you get your 50 to 65? Maybe. One of the things that I would argue in that scenario is, why are you at 50? Is it mismanagement? Is it, the landlord is comfortable with full occupancy and isn't really pushing rents? That's a narrative that you hear frequently from real estate investors, or particularly from brokers. Frequently, it's not true. There may be a reason why: weird layouts, deferred maintenance, rodent issues, things, it's a walk up, not an elevator. And you happen to have a lot of elevators in your market. So if you analyze your market more closely and you remove all those elevator buildings, maybe you're closer to 53 a foot. Right? So market rent relative to property level rent. Real estate is efficient from a tenant standpoint, or we like to think it's efficient, meaning tenants have lots of information, and they're going to pay a prevailing market rent, or they're not going to pay above a prevailing market rent for a property. They'll happily pay less, right? So it's on the landlord to make sure you're getting, or the owner or the investor to make sure you're getting true market rent. But where you're operating in the market is really, really important, because that's gonna kind of put your ceiling on, and your asset is not average. And that does not mean it's above average. What it means is, when we think about averages, we think about, you may be competing with stuff that's way better than your asset, or your asset may be way better than the stuff it's competing with. You just got the best location in the market. Then you ought to be getting a premium relative to the rest of the market. Great, Gerardo, I appreciate the comment. What real estate gets priced like a bond? Why does real estate? Okay, this sounds like a lineman question, or Lindman question, however you pronounce his name. Real estate's not a bond. Lindman has gotten a lot of traction in real estate Twitter, as saying that because real estate investors are talking about real estate in terms of cap rates, it means that they're trading real estate more like a bond. And that is one of the most obscene, and that is not hyperbole. Bond, if you understand what bonds are, you're buying the credit of an issuer, whether it's corporate or US Treasuries. The date you purchase it, you're getting the return promised to you in that bond. And if you hold on to that, you're going to get that exact return, assuming that the bond stays solvent, or the company stays solvent. You're going to get that money to the penny every month or quarter until your principal is returned back to you. Does that sound like real estate? Doesn't sound like real estate to me. We use cap rates in real estate, and this is something that has, I got my real estate finance degree in 2005. Cap rates sort of have been around before then. I'm not suggesting that, but they really, in the last couple of decades, we've started talking about cap rates, and it's accelerated dramatically over the last 10 years or so. It used to be, we talked about things like gross rent multiple. Gross rent multiple is simply what your gross rent is in the at the property level multiplied by some number. If you really know your assets, there's nothing wrong with GRM. Okay. I know real estate investors who focus on walk-up stabilized buildings, and they'll say, I won't pay above a 9 GRM for anything. If you're at a 9 GRM, I know I can make the numbers work. They're doing the same kind of math that a cap rate calculation is. The reason they're doing that, or the way they do that, is they know pretty much to a T what their expenses are in a property. They know what the taxes ought to be. They know what the what square footage is, I should say the expenses per square foot in the building are going to be for every single line item that they have on a rent roll. So it's very sophisticated investing at a very simple metric. Okay. Cap rates kind of eliminate all that need. As long as you're getting accurate information about your expenses and your rent roll, right? It's not being discounted in some way. It's not being, penciled through or some other way that happens frequently. Okay. You can compare the return of one type of asset to another. And it can be in the same asset type. It can be two free market walk-up buildings in Brooklyn, or it could be a truck stop in Connecticut and a Chipotle in Boston, right? They're not the same. They don't have the same type of risk, right? But when you start talking about in terms of cap rate, you're talking about annual return going in. And then you're applying all of the potential income changes over your hold. That is not a bond, okay? And I've read that part of that chapter, and I'm still kind of confused why Lineman said that, because it's sort of absurd. You, as a real estate investor, you're looking at a cap rate at going in, but the minute you buy that asset, the day you close, you start changing what your actual annual return is going to be. And that's because you're deciding where to spend money or not. You've allocated, $50,000 for CapEx, and you decide not to spend that CapEx $50K in year one, you spend it in year two. You've just increased your NOI by $50K. Well, it's not technically increase your NOI, but you understand the difference. You've just increased your bottom line by not spending that money in year one. And you're spending it and pushing it out to year two. And in year two, your rents may be higher. So that $50K actually gets funded a little bit by the building, excess income from the building. That doesn't sound like bond investing to me. That's real estate investing. Real estate investing is not static. It's not, we're not doing credit runs on individual companies to know whether they're going to be able to pay their bond payments or not. We're making decisions based on location and tenancy and upside and all these other things. And we also get variable returns every year, right? Sometimes you do well, sometimes you have expenses you didn't anticipate and you didn't fund for. Okay, so all right, I'll leave Lineman alone. What's the most accurate way to know what a market cap rate is? I think I answered this question. Is the cap rate the only useful in commercial real estate and meaningless in residential? Okay, that's a great question. First of all, I would say that make sure we're talking about, when you say residential, I think what you're saying is single family homes. Residential, when we're talking about 4 families and sometimes 5 families and above, because they're funded differently or financed differently, they are considered commercial properties, because you typically can't borrow the way you can on a single family home. So when you're talking about residential and single family home, absolutely you can talk about it on a cap rate basis. And historically, and this changed sort of in coming out of the Great Recession. I'll talk about why in just a second. But historically, single family homes were not considered institutional investment real estate. That does not mean there weren't some large funds and large developers out there buying and managing single family homes. But single family homes typically have a user premium issue that you have to overcome. And what that means is somebody who's moving to a location to buy that home is competing with an investor, and usually the investor can't pay as much as the user, because the user sees some other market utility that the investor doesn't necessarily see. Right? They're going to enjoy the user is going to enjoy the benefit of the good public schools. They're going to enjoy the benefit of the local parks. They're going to enjoy the benefits of the large yard or whatever. So they're going to bid more than a renter would typically pay for that kind of asset. And the investor is more concerned about what the rent is and less concerned about the market utility. Now, the market utility determines the rent. Okay, we're going to talk about that in the class I'm teaching. But so historically, houses were not a place where institutional investors made big investments the way they have over the last decade or 15 years. That changed for a couple of reasons. The first one was coming out of the Great Recession, a bunch of tens of thousands of single family homes that were had been foreclosed on were packaged together and sold off to institutions at a savage and severe discount, which incentivized hedge funds and others to buy up those assets and figure out a way to make money on them. But it's really easy to make money on single family homes if you're buying them for 40 cents on the dollar, right? That has changed, right? That 40 cents on the dollar disappeared relatively quickly because, people got back into single family home investing or buying, but then simultaneous to that, we had a massive cost of capital change. So institutions' cost of capital went down even further than single family home buyers could, right? Users could. And so they could create some leverage opportunities there because of the low cost of capital that's happened in the last 5 years or so. So that I think is going away. I think that we're going to see less institutional investment in single family homes because now that you have higher interest rate costs, you're going to get downward pressure on those prices. You can talk about single family homes as cap rates, especially if you're thinking of comparing it to somebody who's buying the home to rent it out on a long-term basis, like annual basis, versus short-term Airbnb kind of investment. You can you hopefully are getting a premium above what that would be. So you can talk about it cap rates, but again, it's not typically considered a commercial asset for all the reasons I mentioned. Would you use a percentage or fixed cost to underwrite the cost, time, and money of evicting a delinquent tenant in New York multifamily? That's a good question. I would say that you need to look at the tenant file. I don't know if you have a tenant that's in court for eviction. If the tenant in New York has hired a landlord and tenant attorney, they can drag you out for years. I mean, best case scenario, it's a year. Even beyond that, if they're very aggressive, it's almost impossible to answer that question. I would say that you would want to make sure you look at the tenant file to see where they are in litigation and why they're still there. As long as if you underwrite that you're going to have a potential loss to lease situation because of delinquency, and it's a relatively small amount. This doesn't happen to a huge amount of apartments on a percentage basis, but it happens. So you have to make sure you're considering that when you're paying the prices that you're paying. And that comes again down to the cap rate. In California Bay, high demand market investors are still buying 3-cap multifamily with stable rents. How does this make sense still with current rents already high? I'm not an expert on California. I will say that every investor has a different return profile. If you're okay with a 3% return or 4% return, and there are lots of reasons why people may be okay with that. When I was in grad school, one of the professors worked for a family office. They bought ground leases in New York City, skyscrapers in Manhattan, and the cap rates on those is like 3%. And the conversation invariably with this professor was, "What the hell? Why would you do that when you?" And his response was, extremely wealthy investor, most concerned about return of capital, not return on capital. So if they can diversify their portfolio in high quality real estate assets at a 3% return, and they don't care, right? They don't care about the return. They're not looking for a huge return on. They want to make sure they grow their assets under management, if you want to say that, and in the highest quality location that they're aware of, then it's hard to beat those ground leases, was his thesis. That's obviously changed probably now that we're talking about it. But so you could make that argument in California. I wouldn't particularly make that argument, and I would want to know what the investors are seeing. Are they just parking it there because they just want to own as much of that part of California as they can because they see legislative change, or they just see security in that location? But I would argue that most real estate investors it's not a juice that's worth the squeeze. Would you ever consider doing an underwriting workshop? Underwriting is really just math and kind of looking at the stuff. The assumptions are where the rubber meets the road. And that's more of the class that I'm going to be teaching is why are we making a cap rate compression assumption in terminal value? Why are we should we consider rents peaking at a certain period and then falling? And if so, why? Why does 3% rent growth make more sense than 4%, or 4% makes more sense than 3%? It's thinking through sort of the longer term assumptions that you make and where you can be more aggressive or less. And also, how do you sort of stress test your assumptions? And I think that sort of gets to underwriting. It wouldn't be specifically underwriting, but it's kind of like that. As a new investor buying, is the idea to buy a high cap and later sell to another buyer for a lower cap? I'm just trying to understand the relationship with cap rates and maximizing returns for a multifamily or industrial deal. Okay, so John, that's a great question. I would say that you're burdened with the cap rate environment that you're in. And so high caps and low caps, if the prevailing cap rate in the market is 5%, I would look for something significantly higher than that. And that may require a repositioning. You buy something that needs to be worked. In the business, we call it being worked. You have to work the building to maximize its potential. That's not a cap rate. That's more of a sort of levered or unlevered yield on cost. How can I get that annual return up so that I'm operating at a 7, 8, 9, 10% annual return? And then when I sell that, I can have a much lower cap rate than that annual return I'm getting. That's kind of analogous to cap rate compression, but it's not really cap rate compression, because cap rate compression is you're buying at a 7 cap today without working the building, and you're selling it in 4 years or 5 years at a 5 cap or a 4 cap. That's ideal. That's one of the reasons why I'm so bullish on where we're heading. And I don't think we're done correcting. And I think the correction is going to take a little while to sort of get priced in, and we're going to be operating at a higher cap rate environment for a longer term than a lot of people are saying. Not everybody. I'm not unique in that observation, but that idea. But many people think we're just going to get right back to where we were, and I don't think that's going to happen. But I do think we will get back to much lower cap rates. So I would be looking to buy things that make sense today at a relatively higher cap rate than you've seen in the last 2 years, and operating those buildings and working those buildings to your to the maximum potential that you can. And then when cap rates start to compress, if you want to sell, you've not only increased your rent roll significantly through working the building, but you're also capitalizing on cap rate compression. You're buying at a 6 or 7 and you're selling at a 4 or 5. And that will be a function of two things: interest rates falling because inflation's reined in, and the Fed wants to try to spur investments, so they dramatically lower interest rates. And then everybody gets frothy about real estate again and starts buy. And so prices get bid up, cap rates compress, and then you think about selling at that point.
Kevin, shall I jump in?
Yeah, go ahead. Is this John?
Yes, I'm just trying to understand, because as a broker myself, you're hearing a lot about vendors having to sell with rising interest rates, but we're not really seeing it that much in the market.
I understand. So when
is it coming?
Right. So when you say vendors, I just want to make sure you're saying like the owners, people who
who are selling properties. Yes.
Okay. I want to be careful about making predictions, but I'll tell you what happened the last time around. Okay. Because I was operating in the market when the recession happened. Transaction volume and as a broker, right? Because you said you're a broker.
Yeah.
But even as an investor, okay. Transaction volume from 2007, 8-ish, that range where we were really at the top of the market.
Yeah.
Transaction volume fell roughly 90%. And the only people that were selling were distressed sellers, people that had to sell because prices fell like 50%. So if you're trying to position yourself for that, we're not quite there. We're not there yet. It's possible we won't get there. I do think some markets will see a 50% price correction, at least on a cap rate basis, for sure. I think that's virtually guaranteed in some markets.
It's targeting those markets, basically finding out now.
Yeah,
those might be.
Yeah, or you could be there might be opportunistic ways to do it. Like for instance, somebody is they over leveraged, and then there's a capital call and they've got to sell, and it's not in one of those markets. You just you're known enough in that market that you're a call that's made, right? Somebody says, hey, I've got a seller that has to transact. You've got 10 days to decide, and you got to close in 10 days. If you're fortunate to be in that position, you can take advantage of distress, because there are a lot of people who want to try to do that. I don't think we're going to see 2007 to 9 like that. I think it's going to be closer to what we saw in the 80s, in the apartment market in the 80s, in New York specifically, which is there was a massive co-op conversion craze in New York City in the late 70s and 80s, and co-op prices went up dramatically. Before condos really kind of took hold in New York, in Manhattan, we had co-ops, and co-ops were like, there was a huge craze to convert rental buildings to private ownership, and the co-op converters made a ton of money doing that. And so what happened in the late 70s and early 80s, you saw, and you can go back and look at the New York Times real estate section where it talks about, co-op prices up 100% from 78 to 79, and literally talking about apartments that were trading at $100,000, and the next year were trading at $200,000 and then $300,000. Somewhere around 1985 and 6, there was a pretty big crash. Okay. People who had paid like $700,000 for their co-ops, and these were great locations in Manhattan. Okay. If you could buy that today, you're talking multiple $1 million apartment. $700,000 in 1985. They did not see $700,000 again in absolute price until like 2003. So there was like this long period of just not a lot of growth. Prices declined, but in some of them, if they paid at the top, that they declined significantly. But it's also just this idea where maybe we're entering a period where we're just not going to see a lot of appreciation. Rents are going to sort of, lots of supply has been added to the market. And there's something we call the 4-quadrant model, which helps explain how when asset prices go up dramatically, we tend to overbuild. And we have done that this time around. There's a pipeline of lots of units coming into the market. So that's going to put downward pressure on rents. Cap rates are expanding because they were just too low. Didn't make sense. A lot of euphoria in the market, really cheap interest rates, everybody thinking sort of irrational exuberism. So now we stabilize at like a 5 cap, 6 cap market. If you paid a 3 cap, it's going to take a while to get back to it's not going to never come back. It's just you're not going to have a real estate return for a while. And so we're going to sort of enter a more normalized market, and that's okay. It means that you're going to be making money annually, as long as you're not saddled with legacy assets that are, dragging down your ability to operate. David, is there an easy way to compare or quantify the difference between different spreads between interest rates and cap rates? For example, investor comparing a different deal scenario where spread between interest rates and cap is 50 bips at a lower price and higher. This feels like, and David, I'm happy to talk to you offline. This feels like more of a no. And the reason it's no is because I don't think things really get priced that way. There's a specific margin deal to deal. I think that margin comes in the relative demand for the asset. If lots of people are interested in it, that's going to be a tighter spread. If there's less interest, either because it's poorly marketed or there's something else wrong with it, or the location isn't as great as some of the others, then the spread will be wider. But I don't know of any rules or things to follow. I think, but you're thinking about the right thing. Where is the spread and what should it be? But I think it more like an individual thing.
Can I ask one?
Go ahead.
Let's say hypothetically we have a small multifamily asset that's currently being operated as an Airbnb, and it's proven to be a good Airbnb, and the NOI is more attractive on the Airbnb than it would be being run as a traditional multifamily. So as a broker, when we go to sell it, what's the quote unquote right thing to do? Market it as an Airbnb or market it more towards traditional investment?
That's a good question. The first thing I would say is that you're going after two completely different buyers, but the buyers are competing with each other in the same market. And so what's the highest and best use? And it sounds like it's going to be Airbnb based on what you said. And assuming the Airbnb is legal, sort of perpetual, like it's not going to go away. There isn't some legislative risk there, whether it's is it currently licensed, is the location zoned for this type of use? Because there are some risks there that you as a broker, you have to be real careful of. But assuming all those things are in fact okay, and you check those boxes, I would argue that you're marketing it to both. If you truly have both competing for the asset, then you're highlighting the benefits of both. I think a user, non-Airbnb person would like the flexibility to do that. Lots of people think they're going to buy a home and then hold on to it and buy another one and keep that as a rental. So being in being in the Airbnb business is sexy and all that kind of stuff. And that might be a nice bonus. The Airbnb investor may want a viable exit strategy. And so I would be marketing to them and saying, hey, this is a great Airbnb, but if you didn't do Airbnb, this is what your prevailing rent would be and this is why it's a great exit strategy or backup plan or, whatever. Because Airbnbs right now are suffering, as they should be. If you think about the marginal efficiency of investment, Airbnbs are saturated. It's a market that got saturated by lots and lots of people flooding into that market. And it's predictable that it's the low hanging marginal operators are going to get shaken out of that business, and then there's going to be less supply, which will be better for the longer term operators. But it's a great question. It's hard to say, and especially if it's a really big difference between prices. I would go, if it was me, I would pitch the owner and say, look, much smaller buyer pool of Airbnb buyers, but clearly a much better value, a higher price. The only thing is the buyers, the Airbnb buyers aren't stupid, right? They're not going to pay a premium necessarily if they can buy another property that's being marketed as a single family home, just turn it into an Airbnb. So you have to be cognizant of that too. But I would, from a marketing standpoint, I would do both, to be honest with you. Other questions? I don't know if that answered your question, but